Student loans are like herpes. Most college kids have them, but most of the time you don't realize the impact until it's too late. How are you guys doing today? My name is Apple, and today we are filling in the financial gap between schools and the real world. And thankfully, I am here to educate you and not to tell jokes because, yeah. So today we are talking about student loans. And this is a topic that has so many people confused, and it is so important because it is the #1 source of debt for young people today. It's ridiculous. So many people have student loans, but so few people know how they work and the basics, just the basics of what a student loan even is. So that is what we're going to be covering in this video today. And before I go any farther, the very first thing that you have to do before you go to school, before you think about going to school, is you need to fill out the FAFSA. Free application for student aid, FAFSA. Fill that out. They give you free money. You want free money. School is not cheap. You will take any free money that the government will give you to go to school. So go to the FAFSA. Fill out the FAFSA. That is going to be your best friend. Okay, so now that we filled out the FAFSA, now we can move on to talking about student loans. But you gotta fill out that FAFSA. You gotta do that. Fill out the FAFSA. Alright, so let's talk student loan basics. So, first off, student loans are going to have a lower interest rate than a lot of other kinds of loans. So if you get a federal student loan, the interest rate is going to be about 4.5%. So, talking low interest. So federal student loan, about 4.5%. Private student loan, it's going to be really anywhere from 6% to 12%. So a little bit, but pretty significantly higher. And that interest is really going to add up over time. So you're going to want those government loans before you even look at private loans. So make sure you max out your government loans before you get any private loans. Next, student loans have easy approval. You do not need a high credit score or really any credit score to get a student loan. This is because the government knows this person is a young person, probably, so they're not going to have that credit score behind them to be able to have a credit score. I don't know. So yeah, there's going to be a lot easier approval than other kinds of loans. Next, we're going to look at the different types of student loans. So with your student loans, you've got 4 main types. First type, these are going to be in order of the order that you want to apply for them in and the order of basically how good they are. So first one, #1, is a Perkins loan. So Perkins, that's what you want to go for first, Perkins loan. Perkins loan is #1. You want Perkins loan is a need-based loan. So they're not available to everybody, and they're available based on your need, and these are going to provide the most generous terms. So they're going to have the most flexibility on when you have to start paying it back, when the interest starts accruing, stuff like that. So they're going to allow you to not have to pay it back until you get out of school, which is great because you probably don't have that much money in school, and they're going to allow the interest to not start building up until after you leave school as well, which is amazing because interest adds up over time and you don't want to have to be adding that interest to your loan while you're still in school. Next is a Stafford loan. Stafford loan is next. And Stafford loan is also sort of need-based, and it's going to be less generous terms than a Perkins loan, probably higher interest, but they are going to provide you with more money. So Stafford loans are basically where you go once you max out your Perkins loans, then you move to Stafford loans, which are going to have a little bit higher interest rate, but they are going to let you borrow more money from them. And these are still pretty low interest rates as far as loans go. So definitely go for the Perkins. If you need to max out Perkins, go for the Stafford next. Next we're going to go to is the standard loans, which are from the government. And these are the government subsidized loans and the unsubsidized loans. And these ones are not need-based. These ones anyone can apply for, but their limits are pretty low. So you get standard loans. All right, so with the government subsidized loans, they're not going to start adding interest to your debt until you get out of school and you've been out of school for 6 months. And this is not the case with the unsubsidized loans. So you want to get those subsidized loans first, max those out if you need to, because they are going to provide you with the best way to reduce how much interest you have to pay on this money. So if you're not eligible for those need-based loans, definitely go for standard loans first. And go for those subsidized loans, and if you need to max those out, then move on to the unsubsidized loans. Lastly, we've got our plus loans. These are plus loans. And our plus loans require a credit score, so these actually go under the name of your parents. And these are going to have higher interest rates, and the interest is possibly going to accrue while you're still in school. And these loans just have much less favorable terms than some of the other ones on the list. And they're also under the name of your parents. So if something goes wrong and your debts are on the line, it's really on your parents and it's not on you. So that this is not ideal for parents, because then this could actually screw up their credit score as opposed to screwing up your credit score if it's something that you are messing up on. So plus loans should be a last resort if you are not eligible for the need-based ones and you have to max out your government loans. That's when you should turn to plus loans. All right, so let's talk repayment plans. So with repayment plans, you've got your standard. You've got your standard repayment. And with standard repayment, you start paying it off after you get out of school. That's going to be common across all of these. And you pay a flat fee each month that is going to have your interest and your loan. And this is usually going to be for like 10 years is like the average for how long you're going to be paying these off for. And next we've got your graduated repayment. So graduated sounds like gradual, and your payments are going to gradually increase over time. So they're going to assume that as you get out of school, you're making less money, and about every 2 years, they're going to increase your loan payments so that you can still get it paid off in like 10 years, but it's going to start off with those lower payments and generally move upwards as they assume you are making more money as you are out of school for longer. Next, we've got extended. So extended is just a longer term, which means you're going to be paying more in interest. It's going to be longer than 10 years, but the payments are going to be lower. It's going to be higher interest. Well, not higher interest rate, but you're going to be paying more in interest because you have these loans for longer, but the payments are going to be lower, so probably more manageable. And lastly, we've got income-based. And income-based is really cool because the lender will actually adjust your loan payments based on how much money you're making. So if you get a raise, then you can pay more off. If you get laid off, then they're going to reduce your payments and make it more manageable for you. So the income-based is a really nice way to make sure that you're able to stay on top of your loans and pay them off in a timely manner and not get behind on those. And lastly, with student loans, there's a bunch of tax deductions actually that a lot of people don't take advantage of. So when you're filing your taxes and you have student loan payments, make sure that you are writing off the interest payments, the interest on your loan payments, because this is actually a tax write-off and will save you some money if you do this. So make sure to look for tax deductions when it comes to student loans, because that's free money. All right, so let's say you're on one of these repayment plans and you're no longer able to pay your student loan debt. What happens? So you've got three options. First option is deferring. So to defer on your student loans is to say, okay, I can't pay these right now, so can you just give me a little bit and I will start paying them again soon. And deferring has some specific criteria required for it, and usually lasts for like 6 months. And with some loans, they will actually pause your interest accruing while you are deferred on your student loans. So that's really nice, and it sort of just puts it on pause and allows you to sort of get recovered and get back together before you have to get back to paying these. And some reasons for deferring could be a temporary disability, you could have gotten unemployed, economic hardships, family emergencies, stuff like that could be qualifications for a deferment. Next, we've got forbearing. And forbearing is like deferring, but not as good. So with forbearing, there's very few requirements to do this, and it also puts your student loan payments on pause, but it's going to A, hurt your credit, and B, the interest is going to keep piling up while you're not paying, so the money it's still building up, even though you're not paying, so it's going to be an even worse situation once you get back to it. So you really don't want to forbear on a student loan if you don't have to, but for some people it's the only option, and if they don't qualify for deferment, sometimes you got to do it, but it's very, very not recommended. And next is canceling. So there's very few circumstances where canceling your student loan is going to be possible. One of these could be bankruptcy. However, most types of bankruptcy actually do not dissolve your student loans. So canceling is usually not going to be an option unless there are some very extreme circumstances going on there. Your main option is probably going to be forbearing unless you have extenuating circumstances, in which case you are going to be able to defer your student loans. All right, so now let's talk federal versus private student loans. So with federal loans, A, you're going to have lower interest. As we talked about before, it's going to be around that 4.5% range, whereas private loans are going to be around 6 to 12%. So you're going to have that lower interest, you're going to be paying less money in total over time to pay off those student loans. Next, they're going to have generous payback terms. So governments are going to be more flexible when it comes to how you pay them back, how frequently, and stuff like that. They're going to be much more likely to allow you to defer on your student loans than a private company would, which is amazing. Next, you've got subsidized interest. So with government loans, most of them are going to let you not have to pay off that interest while you're in school. They're going to give you this grace period of while you're in school for the interest not to add up, which is amazing. But even with those unsubsidized loans, there is still an option that is going to allow you to pay less interest over time, and that is called pay-as-you-go. So when you're establishing loan terms, you want to try to get loans under pay-as-you-go terms versus capitalizing interest terms. So with pay-as-you-go, you are going to be paying that interest off right away, and the interest is not going to, there's not going to be interest on the interest, and the interest is not going to compound, which, as we talk about in lots of videos, compound interest is great for multiplying your returns on investments, but it's also great for getting you into loads of debt. So if there's that option to eliminate compound interest from the equation, you're going to be much, much better off. So you want to get those pay-as-you-go terms on an unsubsidized loans. And lastly, with federal loans, they can be forgiven. So some circumstances where your loans would be forgiven are if you are a government employee, or if you're a teacher, or if you have nonprofit, if you're doing nonprofit work. All three of these are circumstances where the government may decide to forgive your loans, and that is amazing because you just saved yourself all of this money that you had to pay back, and now the government's like, nope, you don't have to do it anymore. So great. All right, so private loans. No matter what any company or lender tells you, private loans are going to be less desirable than government loans. So first off, they're going to have that higher interest rate. They're going to have high interest, as we talked about before. So there's that. Not much more you can say about high interest. Next, they don't care how much you want, how much money you want. They will give you so much money because they know that means they're getting so much more money in interest. So it's a lot easier to get sucked into taking out more debt than you need with a private company because they don't have these limits. They don't have these low limits on what you can borrow. So this is good because it allows you to pay for more education, but at the same time, it's gonna get you into a lot of debt, and they don't care because they just want those interest payments. So you going into debt is not their biggest concern. And lastly, they're going to be a lot less accommodating and have less clear terms on their loans. So with government loans, they're all pretty standard. You can really find most of the basic terms of a government loan online. With private companies and private lenders, the terms are a lot less clear, they're a lot less standardized across all lenders, and they're going to be a lot less accommodating to you. Deferring is going to be hard, if not impossible, and they're not going to forgive your loans if you're a teacher or if you're a government employee or anything. So make sure that you know your loan terms before you get into something that is going to be very detrimental to you in the long term. And really the bottom line here is just to be asking for discounts. Ask for any discounts you can get on your student loan. A lot of government loans, if you have timely repayment and if you are doing good in paying off your loans, they're going to be able to give you discounts, which is great. So always be asking for that, because free money is amazing and less student loans is fantastic. Next, take as little as possible. Do not borrow more money than you need to. This is big. The interest payments are going to add up over time, and if you're borrowing more money than you need to, just because you see it as free money, it's not free money. You have to pay it off. You have to pay interest. So do not take more than you need to, because this debt is going to be with you for a long, long time. And the less there is of it, the better, and the quicker you'll be able to get back on your feet and be financially stable and be an adult. So that's great. Next, apply for scholarships. Scholarships will save you so much money, and they're basically free money. And yes, so scholarships are great. And lastly, increase your income. So this can help you pay off your student loans faster and be more financially stable and get on your feet. And some good ways to do this are either get a part-time job in college, which I would recommend, or get a side hustle in college, which I would also recommend, or do both. And I have videos on both of these topics, and they'll be in the description, so definitely check those out and figure out ways that you can increase your income in order to pay off your student debt faster and have to take out less student debt in general. And for our question of the day, do you have student debt? Are you going to need to take out student debt? What do you know about student debt, and what questions do you still have? Let me know in the comments below, and I will respond to them, answer them, and possibly feature them in the next video. And if you enjoyed this video, please leave a like and subscribe to be notified whenever I put out any more videos like this one. And until next time.